Hello, Neel Kashkari, and thank you for taking the time today to help us get a better sense of the state of our economy and for sharing your thinking on how community foundations might be able to help drive an equitable recovery after the pandemic and ensuring widespread prosperity in communities large and small from coast to coast. So we really look forward to this conversation between you as a leader at the Fed and Laura Gamble, a former Community Foundation trustee who's also a banker. Now, before I turn this over to Laura, I'd like to provide our audience with just a bit of information about your background and experience. So Neel Kashkari has been President and Chief Executive Officer at the Federal Reserve Bank of Minneapolis since 2016. He oversees operations and leads many special initiatives, including the Opportunity and Inclusive Growth Institute, whose mission is to ensure that world-class research helps to improve the economic well-being of all Americans. Most recently, he's joined with retired Minnesota Supreme Court Justice Alan Page to propose amending Minnesota's Constitution to make quality public education a fundamental right. Last fall, he also launched the 7-part Racism in the Economy series with a promise to take a frank look at flawed systems, including within the Federal Reserve, that have perpetuated discrimination. In addition to his work at the Fed, Neel has worked on Wall Street and held several senior positions in the US Department of Treasury. We're very lucky to have Laura Gamble here to lead this conversation with Neel. She's the Regional President in Greater Maryland and Northeast Territory Executive of PNC Bank. She also brings the perspective of a community foundation trustee. She joined the board of the Baltimore Community Foundation in 2006, was chair for 4 years, and is now trustee emerita. So now I'll turn this over to you, Laura, and we really look forward to a rich conversation.
Thank you so much, Deborah. And Neel, thank you so much for being with us here today. I think this is going to be a terrific conversation and eminently helpful to our communities from coast to coast. So with that, I'm just going to dive right in. As you heard, I was a board member, I'm still a board member of the Richmond Federal Reserve Baltimore branch. And one of my responsibilities there is really to help connect the Fed to the business community and to the community at large. You know, in that, I have found that people generally just don't understand what the Fed does and what it's responsible for. So how do you describe the Fed's role in layman's terms?
Well, first of all, thank you for having me. It's great to be with you. And thank you for your service on the Richmond Board of Directors there. So Congress created the Federal Reserve in 1913. And our basic job is to try to manage the ups and downs of the economy. Congress has told us, deliver an economy that's growing stable. So we have a 2% inflation rate, but think of it this way. Think of an economy that is growing at a stable rate and an economy that has maximum employment. As many Americans as possible are gainfully employed and contributing to our economy. And the reason that Congress created a Richmond Federal Reserve and a Minneapolis Federal Reserve and 12 Federal Reserve banks around the country is they wanted all of the different regions of our country involved in that process, and to make sure all of those regions were represented as the Federal Reserve sets interest rates to try to manage the overall economy. And so our individual banks play an important role, and our boards of directors and our branches and our branch boards of directors play a really important role to make sure that we know what's happening across this enormous country of ours so that we can bring that information together and make the best possible decision for the country as a whole.
Thank you for that. You mentioned inflation, and obviously there's been a lot of discussion in the press lately about the recent spike in inflation, and whether or not it's a temporary situation or if it's deeper than that. What are your thoughts on that? And in either way, temporary or not, what does that mean for the economic disparities that exist in our communities?
Well, this is a complicated question. So the economy was in quite a strong position before COVID hit. We had a very low unemployment rate, around 3.5%, and Americans were, especially lower income Americans, were finally starting to enjoy higher wages. Then the pandemic hit and the economy went through an abrupt shutdown and is now reopening. Well, in that shutdown and that reopening, some sectors have struggled to keep up. So first of all, people felt much more comfortable buying goods, let's say buying stuff on Amazon, than they did going out to restaurants or going out to the barbershop or the hair salon. So there was a shift from services to more goods purchasing. So we started seeing certain sectors have a lot of demand, and it was hard for those sectors to keep up with that demand. So I'll give you an example. A year ago, when I go to the grocery store, it was very hard to find toilet paper. Everybody was working from home and they were buying more toilet paper at home. Well, now toilet paper is plentiful. You go to the grocery store. That's an example of there was an adjustment. Prices went up for toilet paper. There was scarcity. Now the supply chains have caught up. Similarly, if you look at lumber prices skyrocketed 6-9 months ago. They've now fallen back down to earth. So as the economy has gone through this rapid shutdown, rapid reopening, rebalancing from services to goods, and now hopefully back to services, we are seeing some sectors continuing to struggle. So there's been a lot more demand for cars. So the auto sector has been a big source of the increase in inflation, and the suppliers to those auto companies have also been under a lot of pressure. So it's a very complicated situation. My base case scenario is that these are going to work themselves out. It's not going to be a permanent high demand for autos. There's not going to be a permanent high demand for toilet paper at home or for lumber. But some of these adjustments are taking more time. And so that is affecting people's livelihood because the prices people are having to pay are real. But we are also saying, what's the long-term trajectory of the economy? We don't want to overreact to short-term price movements. We want to make sure we can get the economy back to full strength and put as many Americans back to work as possible.
So in terms of disparity, this too, I mean, it's not going to help obviously bring low to moderate income people closer to the high income people in the short run, but it's not going to exacerbate it either.
Well, I think that importantly, the most valuable asset that the vast majority of Americans have, because they probably don't own their own home or they don't own stocks, it's their job. So putting Americans back to work, the 5, 6, 7, 8 million Americans who are still not working, who would have otherwise been working had there not been a pandemic, making sure that they have the opportunity to get a decent job, hopefully enjoy higher wages. We don't want to shortcut that. I mean, that is so important to reducing inequality. To me, that's our highest priority, put people back to work. But we also, of course, are going to pay very close attention to inflation to make sure that we keep it within check and achieve both of our goals.
Well, with regards to getting people back to work, obviously right now, we still haven't gotten back to pre-pandemic levels. And I can tell you just from the people I work with, there's a lot of shortages, a lot of job openings that haven't been filled. What's your perspective on that? Is that too just a short-term issue, or is it longer-term in nature?
Well, even before the pandemic hit, for years, since I've been at the Minneapolis Fed, I've been hearing businesses saying, oh my gosh, we have a worker shortage. Meanwhile, they weren't raising wages very much. And it's a very curious thing. If the price of oil goes up or the price of corn or steel, businesses may not like it, but they shrug their shoulders and say, that's the market, I've got to pay it. But if they can't find workers lined up down the street at wages they're used to paying, they immediately say, historic worker shortage, this is a crisis. Well, maybe you just need to pay more to get the workers that you want. So that dynamic has been going on for a long time. I don't think that's going away. But right now, there are still some barriers keeping people off the sidelines. And one of the big barriers, frankly, is fear of COVID. The folks, lower income workers are generally the ones working in these frontline service industries. They are the ones with the least access to quality healthcare. They're the ones most at risk of getting COVID. In many cases, most at risk of having a severe outcome from COVID. So I think a lot of Americans are still afraid. And when are we going to overcome that fear? When are people going to have confidence that it's safe to go back to those old jobs or related jobs? I think that's going to take more time. And you start seeing, the Delta variant obviously is spreading like wildfire across much of America. That also is increasing people's nervousness. And I understand that. Just one more second on this or minute on this. in Minneapolis Fed, we adopted a vaccine mandate in early July. We are now around 97 or 98% fully vaccinated in our bank, which is wonderful. I'm so appreciative of all of our employees going ahead and getting vaccinated. We still have employees who are nervous about saying, hey, I'm going to come back to the bank. And we say, well, look, virtually all of your colleagues are vaccinated, but people are still nervous. And so I think it's going to take time for people to feel confident to get back on the subway, to get back on that city bus, to be able to go back to their old in-person job. And we're just going to have to be a little bit patient for that.
No, I think that's a good point. We're definitely saying that in my own organization as well, that just even among the vaccinated, some hesitation. So I think that's a great point. Kind of going back to your earlier reference about the Fed's mandate, full employment, 2% inflation target. You know, we as we discussed, there's a lot of discussion around inflation, but not so much on interest rates in the last decade, which have remained historically low, even pre-pandemic. And low interest rates are great for borrowers, but not for savers. And why don't we discuss that more often?
Well, I'll tell you, we hear about it, and I hear about it from constituents all the time. And I imagine that my colleague at the Richmond Fed, Tom Barkin, also hears about it, as do all the other Reserve Bank presidents. And here's a complicated answer, which is, the Federal Reserve sets interest rates in the short run. We move an overnight interest rate called the federal funds rate up and down, and it has some effect on longer term interest rates. But longer term interest rates are really set by the broader forces of the global macroeconomy. So what creates an interest rate? Well, it's the balance between savers and how much they save and businesses who say we want to invest. And that balance between savings and investment leads to an interest rate where those two things are in balance. Well, if you look around the world, in advanced economies all around the world, over the last 20 or 30 years, interest rates have been gradually declining. They're not actually declining because of the Federal Reserve or the ECB or the Bank of England. They have been declining because of broader macroeconomic forces, such as the aging of our societies. Advanced economies are all aging. They're all getting older. And it turns out that older people tend to save more and spend less. So there's more savings than there otherwise had been. Also, technology developments and trade developments, that's led this interest rate down over time. So if the neutral interest rate is gradually declining, the interest rate that neither stimulates nor restrains the economy, central banks are managing interest rates around that trend, moving them up and down, but we're not setting the trend. So I understand that savers would like higher interest rates, but if we just said we're going to raise interest rates to make savers happy, well, if the neutral rate is down here and we just say, well, we're going to raise interest rates to make savers happy, there's a good chance that we'd end up slamming the brakes on the economy because that interest rate was too high for the economic fundamentals. So I know that's a complicated answer, but that's driven by broader macroeconomic forces. And we are recipients of that. We have to respond to that. We can't ignore that.
No, I think that's a great answer. I think it is obviously a very difficult trade-off. And I think it is not always easily understood. So the talk about inflation pre-pandemic was around the Fed's 2% threshold, and whether or not we were consistently hitting it, and we were always sort of falling a little short of that. Obviously, right now we think we've temporarily exceeded that, but do you still think 2% is a meaningful target? Or I would maybe even broaden that conversation to, do you think that inflation and full employment are really the right targets for monetary policy, or have there been fundamental changes in the economy that might point to a different mandate?
No, I think that those dual mandate of inflation and maximum employment make a lot of sense. And the way I look at it, I look at them as two sides of a seesaw. So when the economy heats up, businesses have to compete to find workers as they're competing with each other now, and then they have to pay up. So you think the unemployment rate would go down and wages and then inflation would go up. So what we're trying to do is balance these two sides of a seesaw to have an economy that's growing at a steady rate, but have as many Americans as possible gainfully employed. So I think those are the right things to focus on. Now, a lot of people will say to me, Neel, I don't understand why 2%. Why not 0? Wouldn't 0 be better? And 0, obviously, why do you want prices going up over time? Well, for a bunch of complicated factors, which is that lower, interest rates have been falling over time, it's very hard for us to cut rates negative, even if the economy were to demand negative interest rates. And so having a 2% inflation target gives us a little bit of buffer, a little bit of room to stay above 0, and it helps us avoid deflation. And so here's what I mean by that. If I take out a mortgage, if you were to give me a loan to go buy a house, but prices are falling in our economy instead of rising, or instead of staying still, then my debt is proportionally getting bigger and bigger and bigger relative to the value of my house. Well, that ends up being a really bad situation for an economy. So we want to avoid deflation. So having a low inflation target gives us a little bit of room, a little bit of margin for error. And as you said in your question, prior to the pandemic, we were struggling that we couldn't actually hit our 2% inflation target. We were coming in around 1.5%. That doesn't seem like a big deal. But if our target had been 0 and we'd been missing below it, we would be in deflation, which would be bad for the economy. So we need a little bit of margin. And I still think 2% is right. Let's just go achieve it over time.
Well, I think that the frequent example of negative interest rates is Japan, and how their economy has struggled over decades with the prospect of deflation. So I think you have a lot of support for that perspective, at least with the people that I talk to. Nobody wants to see that. So you mentioned earlier, there's Fed districts all over the country, and so in working within, historic districts, which may not necessarily reflect where the population is now, but what do you see as, are there significant differences in the regional feds? Is your focus significantly different, say, than maybe the Federal Reserve Bank of Cleveland or Richmond?
Well, going back to what we started with, Congress's intent in 1913 was to make sure all the regions of the country were represented in this process. So some things are common. I know that researchers at the Richmond Fed and the Cleveland Fed and the Minneapolis Fed are all doing their best to try to analyze the status of the US economy as a whole. And we share research, and we work closely with staff at the Board of Governors in Washington to get their latest thinking as well. So that's common. But there are regional differences. I mean, the district that I cover is very different with Montana, North and South Dakota, Minnesota. It's very different than the Richmond district or than the Cleveland district. So first of all, that regional intelligence, that regional focus on what's happening on the ground in our districts, that is unique to each district. And I know each district works very hard to make sure they know what's happening in their local and their regional economy. And then there are research areas of focus. So in my introduction, we launched the Opportunity and Inclusive Growth Institute, which is a research think tank, you could think of it that way, focusing on issues of economic disparity in our region, but also nationally. And so that's a big area of focus for us. We also have a research center called the Center for Indian Country Development, because we have a lot of tribes in our region. That's another area of focus for us. Other regions have different areas of focus. I know in the Cleveland Fed, which you mentioned, that President Mester launched a research center focusing on dynamics of inflation. And we all care about inflation, we all research inflation, but they have a very focused research effort on that. And we're excited to look at what research they produce. So I think we see a lot of benefit of having these 12 distinct independent Federal Reserve banks conducting their own research. In some cases, they may be analyzing the same problems, bringing different perspectives. In some cases, they might be analyzing different questions. And I think we all benefit from learning from one another.
Well, I would just say that I think in that regard, you have a lot of commonality with the community foundations that are in the audience, because there's community foundations in practically every community across the country, and they, like you said, share information through CFLeads that's common to everyone, but also obviously individual community differences and where their areas of focus are, which I think is just another great reason why they're hearing from you today, to sort of hopefully maybe build some better connections with the Federal Reserve banks in their districts. So
for sure. And, just one example of that, I know the Boston Fed has had a big project on working cities, to how do you take these mid-sized cities and how do you revitalize them? And they've done that work in partnership with foundations in the New England area. And I think that's been a very successful partnership. So we think, I know all of my colleagues across the system believe that community foundations are and can be great partners with each other, but also with the Federal Reserve banks to bring our best research to the table. They can help in many cases take those ideas and put them into practice with their own partnership and their own charitable work. So I just think there are great partnerships there and more to be done.
thank you. I totally agree. There's some great synergy there. And I think that leads me to my next question. You're one of 3 Federal Reserve Bank presidents that initiated a series you mentioned earlier, Racism in the Economy. I was fortunate enough to be able to see some of those, and I would encourage everybody to go out there on YouTube, and they're really great pieces. How long had you and the others been thinking about this, and what do you hope that the video series will accomplish?
Well, this was inspired, unfortunately, by the murder of George Floyd. And when that was such a shocking event here in our hometown of Minneapolis, I asked my colleagues the question, what we need to do more, what more can we do? Yes, we launched our research center focusing on disparities, but we have to do more. What more can we do? So I called my colleague at the Atlanta Fed, Raphael Bostic. I called him because Atlanta is in many ways an epicenter of these issues, just like Minneapolis is. And I said, is there something we too could do together? It'd be more powerful than if it's just the Minneapolis Fed. Our staff started talking. They said, you know what, let's get Boston involved. So then we started the 3 banks, Minneapolis, Atlanta, Boston. We conceived of the series, we launched it. And before we knew it, all 12 Federal Reserve banks said, no, we want to be part of this as well. We have a role to play. We have a contribution to make. And so I'm really proud that all 12 Federal Reserve banks are sponsoring the series on racism in the economy. And it is doing a deep dive, bringing in experts to have brutally honest conversations about racism in housing, in education, in healthcare, in the criminal justice reform, criminal justice sector, among others, to say, let's be honest about what the situation is. Let's have people on the ground bring forward their ideas of policies that could really make a difference. And let's also examine what role the Federal Reserve can play. There's stuff that we can directly influence. There's stuff that we can influence through our research. There's stuff that we can influence through our bully pulpit and our platform that we have. Let's do everything we can do within our sphere of influence to try to make a meaningful contribution on this. And so I'm excited. The series has generated widespread national interest. We've had wonderful speakers who've been very, we told them, don't hold back, and they have not held back. They've given us a very honest assessment of where we are and the little progress in many cases that we have made. And they've brought forward ideas that are actionable, that can really make a difference. So right now we're in a process in the Federal Reserve System of examining what we can do internally to make the Federal Reserve better reflect all Americans that we are charged to represent. And we are working through some of those ideas now and looking forward to unveiling them when the series concludes.
Well, based on that, are there any takeaways or messages from that series that would be particularly relevant to our community foundation audience? Are there any takeaways or actions that they could undertake based on that?
Well, I would just first of all ask yourselves, have you made real progress in your communities? And in Minneapolis, I'm going to tell you something. In Minnesota, we have a very rich foundation community. We have a very rich nonprofit community. We have, Minnesota, I'll just be honest with you, 5.5 years I've lived here. This state is world class in talking about equity. I've never lived anywhere where they talk about equity as much as they talk about it in Minnesota. And we have made zero progress, zero. And so the disconnect between the talk and the reality on the ground is profound in Minnesota and frustrating. And so I would challenge the folks watching this to have an honest conversation. Have you made progress? And don't just say, well, we can trot out one individual family that we helped. Everybody can do that. Have you made real progress? And if not, then by gosh, don't keep doing the same thing you've been doing. Identify transformational changes that are going to be upsetting to some people and go pursue those. So in Minneapolis, in Minnesota, we at the Minneapolis Fed have partnered with former Minnesota Supreme Court Justice Alan Page to try to transform Minnesota's worst in the nation education system, worst in the nation in terms of some of the worst economic and racial disparities and outcomes for kids in Minnesota. And how are we trying to tackle that? Well, we're trying to create a civil right by amending the Minnesota Constitution to create a civil right for every child to receive a quality public education, and then make delivering on that right the state's #1 priority. So that's an example of what we believe can be transformational systematic change. Enough talk, enough little changes around the margins, transformational change. And so I would ask your viewers, all the great foundations, do you need transformational change in your region? Is your focus and your agenda really going to meaningfully lead to transformational change? You know, I can't answer that, but you all can answer that for yourselves. And that's where I think we need to, if we really want to tackle these issues, we got to get serious. Can't keep doing what we've been doing.
I agree with you. You know, in my community in Baltimore, we had our reckoning in 2015 with Freddie Gray's death that has produced a lot of soul searching and asking those questions. And it's not easy. To your point, I think a lot of us in the foundation communities are used to transactional services that, to your point, help one family at a time, help one person at a time. But really dissecting systems and producing systemic change, especially when you're trying to dismantle systemic racism, it's a much more difficult process. But and we've undertaken a lot of education and a lot of learning around really identifying how systems produce disparities and how do you then go about systematically, you know, dismantling that. So it's not quick or easy work. And it kind of leads me to my next question, which is, you know, we have a lot of disparities in our communities by race, gender, other identifiers. Has monetary policy contributed to these disparities? And if so, how?
Well, you know, I hear this a lot, especially on Twitter. You know, there are lots of very opinionated people on Twitter who say, oh my gosh, low rates are leading to a high stock market, and that's ballooning wealth inequality in America. And I always point out to them what I said earlier, which is the most valuable asset most people have, because they don't own stocks and they may not own their own home, is their job. You think about this. Think about a job that pays $30,000 a year. What is the asset equivalent to a $30,000 a year income? How many assets would you need to produce $30,000 a year of income? Well, at a 10% interest rate, that's a $300,000 asset, but where are you going to find a 10% interest rate? At a 1% interest rate, that's a $3 million asset. So jobs are enormously valuable to people. And so by pursuing monetary policy, using all of our tools aggressively, we are trying to achieve maximum employment where everybody can participate. And as I said, before the pandemic hit, people were saying, oh, your monetary policy is too loose. We were achieving a 3.5% unemployment rate. The lowest income Americans were enjoying the fastest wage growth, and they were long overdue for a raise. So I do think monetary policy has a role to play by actually delivering on true maximum employment. That can do a lot of good to help communities all across our country, and it works at scale. One of the real challenges is, you know, fiscal policy programs or targeted interventions, they can work at a very local level, but how do you scale them up to the country as a whole? It's very difficult. Monetary policy works at the scale of the nation. And so we are going to use our tools to try to put all Americans back to work. And I think it's a lousy trade-off. If somebody said, and people have said this to me, you want to raise interest rates to try to bring the stock market down. Well, you know who's going to pay the price for that? All those workers who are on the sidelines, who want a job, a decent job, and a decent wage. I think it's a lousy trade-off to say we're going to go hold Wall Street down, and we're going to do that by keeping millions of Americans out of work. I think that's a very unfair trade, and I would never support that.
Well, I agree with you. Work is incredibly important, not just from a financial perspective, but I think in terms of personal dignity and in many other ways other than just the financial component. But we still have a huge portion of our workforce who are having to work multiple jobs to sustain themselves. So I think there is still very much an issue of jobs, living wage jobs, and how do we impact that, right?
I couldn't agree more. And this goes back to a little bit another dynamic that's been taking place over the last several decades, which is the balance of power between the business owner and labor. And over time, all of the economic research has shown that the owners of businesses have been getting a bigger and bigger share of income, and the labor sector is getting a smaller and smaller share. And it manifests itself a lot of different ways. One way is the income itself, which we were just talking about. But I'll give you another example. There's a convenience store around the corner from where I live that I go to buy, diet drinks and whatnot. And I was talking to the owner, and he said, "Oh my gosh, it's a terrible worker situation. I can't find any workers. I've got 5 of these stores. I can't find any workers." And I said, "Well, is it worse than normal?" He said, "Yes, it's much worse." He said, "Usually, when I put up a help wanted sign, that day I have a line of qualified people that I get to choose from. Today, I'm not getting anybody. This is a disaster." But just think about that for a second. In his mind, a normal economy, he puts up a help wanted sign, and he has a line of workers ready to work at his convenience store, and he can pick and choose. Does that sound like an economy that's in balance? No. We have just gotten used to, over the last few decades, the idea that you put up a help wanted sign, workers will be lining up, grateful to take whatever you will give them. That, to me, does not strike me as balance. And so I'm not saying we should be in a historic worker shortage all the time, but I do think a healthy economy is one where businesses actually have to work hard to invest in and find the workers that they want, and workers should have choices too. That, to me, is an economy that is more in balance. And so we're not there, and we need to get there.
I think that's a great point. And we seem to vacillate between, to your point, an overflow of available workers to now, post-pandemic, virtually none. And how do we move more towards a consistent middle ground with
but I think right now the pendulum that you're talking about that has swung so far in one direction, that's an artificial situation we're in because of the pandemic, because people are nervous for a good reason, about their own health and their own safety. And so I don't want to overreact to this is the new normal that we're in. We need to get past the pandemic, get people feeling safe again, and then assess where we are in that balance.
What's your best guess of how long that's going to take?
It's a good question. I mean, we have world-class health experts all around the country that we've been consulting with throughout this pandemic, and nobody, first of all, they didn't know that we were going to get these great, wonderful vaccines. That's a positive surprise. But then I certainly didn't guess that half of America would not take vaccines, or whatever the number is, such a huge percentage. And so, I don't know. And, we're planning at the Minneapolis Fed. We're basically fully vaccinated now. So we're starting to make plans to bring everybody back at the beginning of the year kind of time frame. It's going to take time, and it's going to be it was very quick to shut things down. It's just going to probably take months, and hopefully not 6 months, hopefully not another year, until we can get things fully restored. But it wouldn't surprise me if it takes 6 months or most of next year to get people fully back to work.
I think for my own business planning, I feel like it'll definitely be the back end of 2022 before we start to feel something that seems a little more normal.
Yeah, I think you're probably right.
But thank you for that. The other discussion I know we're having a lot here in my organization, as well as you're seeing it a lot in the press, is that from an employment perspective, the data suggests that women were more impacted by job loss than men. largely because of the family caregiving responsibilities, lack of available childcare. Obviously, a lot of schools were sent everyone home to be homeschooled. Is that something that we're going to recover from quickly, or is that a potentially longer term drag on the economy?
Well, it's a really important issue. I mean, some of the long-term drags on the economy, we're not going to understand them for quite some time. And so the effect on women absolutely has been profound, both in terms of the nature of the jobs that more women had than men. They were more disproportionately affected. And in many cases, the caregiving responsibilities disproportionately falls on women. And so those are profound effects on their careers, on their futures. And then also on kids. I mean, we still have no idea, other than to say it's bad, we have no idea the magnitude of the learning loss that took place amongst American kids last year. And you hear the anecdotes about how many kids just disappeared from the school systems.
Yep. And
the school said, oh, we have a laptop available, and their families never checked it out. They never were able to log in. And so we're all going to be recovering from this for a long time. And that is, by the way, that is another role that community foundations can play and really focus on. And let's try to get those kids back. Let's try to get those families back. Let's try to invest in them with after school programs. Let's invest in them with summer school programs so that learning gap is not with them for the rest of their lives. And so it's just there are huge consequences for society and for those individuals and for those families. And I would just say humbly, that could be a big area of focus and an acute need that community foundations, I think, would be well positioned to help step in on.
Well, a corollary to that in our community that arose is the digital divide.
Yeah. And
that is, urban and rural communities alike, I think that was really punctuated during the pandemic in terms of disparities.
For sure. I mean, it existed before, but never did we understand it as acutely as we did now with learning. Think about telemedicine. On one hand, now all of a sudden we realize, wow, telemedicine can work, in a lot of cases, and that's great, but you got to get connected. And so the hope is that this infrastructure bill, this bipartisan bill that is pending, is going to make a major investment in making sure that broadband is affordable and available to families all across America. And that can lead to new economic potential as well, because now all of a sudden people might be able to do jobs that they couldn't have otherwise done. And maybe they can get cheaper housing somewhere else and still be able to do the job that they want to do. So there's a lot of opportunity, but we have to close those divides, just as you said.
Well, and we have seen also it kind of created, another divide, which is those who only could show up to work in person during a pandemic versus those who had the flexibility to work from home. And, yet another disparity, what type of, that those jobs tended to be the lower paying jobs where you have to show up and are considered essential. So it just feeds into so many aspects of the labor force.
For sure. And I mean, this pandemic was just profoundly unfair for the reasons you said. So I was able to work from home. I'm in my basement. I'm still working from home largely. Meanwhile, I have access to great healthcare. Meanwhile, I'm perfectly safe working at home versus the grocery store worker that I bump into who checks out my groceries when I go to the grocery store. He or she is a frontline worker, makes little money, maybe doesn't have healthcare, and is also exposed to the virus every day that they're interacting with customers. And so this was a profoundly unfair pandemic in many, many dimensions. And we need to work extra hard to try to close the gaps that have expanded because of the pandemic.
Well, another impact that we saw in the impact of the pandemic on the economy is that so many people in the U.S. are now engaged, to your point, in low-wage service jobs and the gig economy. And those workers are really vulnerable to economic shocks like the one we just saw. So, what does that mean for us as an economy going forward? Do you see, I don't know if you see a potential shift, but those services are still very much in need. But how does that get addressed?
It's complicated, and it's going to take a while to figure out how it shakes out. Before the pandemic hit, when I would travel, I was a pretty frequent Uber customer. And I would often talk to the Uber driver just to get a sense of, hey, what's your experience like being an Uber driver? How long have you been doing it? The vast majority of Uber drivers that I ever interacted with, this was a side gig. They had a day job and they said, yeah, I could watch TV tonight, or I could go out and make a few bucks driving around. I might as well go make a few bucks driving around. So the genius of this Uber type economy, this gig economy, is it's tapping into untapped labor, which is that extra hours that person had 10 or 20 hours a week beyond their full-time job. And those drivers would tell me, yeah, I'm willing to make just a few bucks. I don't need a big wage because this is just an extra kick for me. Well, if you add up all of that extra time that's been available, it turns out that's a lot of source of labor supply that increases our economy's potential. So on one hand, I think it's great for the economy because it's tapping into this new, previously untapped supply of labor, of people's extra time. At the same time, I think it creates challenges, and it's probably the analysis that I've seen, it's a very tough job if that's going to be your only full-time job. So I think there's a lot of things that still need to be worked out, again, to find that sustainable balance where we get the benefits of this innovative, flexible, new style of work, and you don't want people being exploited. And so I don't know that we figured it all out yet. But just yesterday, I was busy. My wife was busy with her job. She ran to pick up the kids. I ordered dinner on DoorDash, and it was great. Somebody brought us our meal. Worked out great. But I've also heard a lot of complaints from DoorDash drivers saying, hey, I can't make a living on this. And so how this shakes out to a sustainable new system, I don't think we're there yet.
Yeah, I too talk to a lot of Uber drivers. I was a big Uber user prior. I will say I've only been back a couple times in recent times, but I would say to me the difference is, are these folks adding to their income by choice? To your point, are they making the decision, the utility of I'm going to earn more money or I'm going to watch TV, or are they having to do this to make up enough money to live on because their first job is not enough to sustain them? So I think we have to think about I think it's a great thing if you're just using it to supplement your income, but if you needed to live on, to your point, I don't think it's a sustainable situation.
That's right. But keep in mind that comment that you just made, which I completely agree with, in the context of all of the complaints from businesses right now that they can't find workers. So the gentleman who dropped off my DoorDash yesterday is making a choice that DoorDash job is better than his alternatives. Maybe better in terms of flexibility. I don't know if it's better in terms of pay, but why isn't he going to Target or Walmart or Amazon and just saying, I'm going to go work there? And so I think all sides of this conversation are important, because if we just listen to the businesses who are saying, my gosh, we can't find workers, we get an impression that workers have all of these wonderful choices and nobody's having to work extra hard just to survive. But then when you actually go talk to workers, which I do a lot of, you get a very different message. And so it's a very complicated picture.
I don't disagree. And I think, those are the questions, right, that we don't always get timely information to, which is, do you know what your choices are? And, are you consciously making this choice, right? But that's really hard to your point. I think it's really hard to get to the bottom of that. So the community foundations that are listening in, like we've said before, they represent, all sizes, all different types of communities. And, they're typically endowed, strong civic institutions with really strong local relationships and a broad mission to build healthy, resilient communities. So how, you've mentioned some ways that you think they can be engaged, but, particularly how can they help build back better in our communities?
Well, I think it's the two things that come to mind are one, which I've said, which is challenge yourselves, challenge your communities to say, are we actually accomplishing what we are setting out to accomplish? And by the way, it may well be that some foundations say, look, we want to support ongoing services that are in need, healthcare services, food pantries, et cetera. That's important. And I don't mean to dismiss that at all. But a lot of foundations that I come across say, no, we want to have a fairer society. We want to have a more equitable society. That's our mission. And I would challenge you to challenge yourselves. Are you making a progress on that mission? And if not, you've got to do something fundamentally different. All of the systems that we have today, virtually all of them, are working exactly as they have been designed to work. That may not be the official slogan of the system,
right,
but they are actually working as designed and as intended. And there are people who are absolutely benefiting from the system as it is today, delivering the outcomes as it is today. So why is systems change hard? Because the people who are benefiting from the system today may tell you they want it to be fair and equitable, but they actually don't want it to change if it means that the benefits that they're enjoying are no longer so rich. So I would just say to the foundations, confront that. You are pillars in your communities. You are respected institutions in your community. Go force people to answer, why don't you want this to change? You know, in Minnesota, again, Alan Page and I, Justice Page, have proposed creating a civil right for every Minnesota child to receive a quality public education, not a private education, a public education. And then delivering on that quality public education should be the state's #1 priority. We've attracted bipartisan support. Democrats of color, conservative white Republicans from greater Minnesota. We've attracted the biggest businesses in Minnesota to support it. And Minnesota's own Attorney General, Keith Ellison, is a passionate supporter. And I know he's going to be a speaker coming up for your event. Who's against it? Who could be against a civil right to a quality public education? You know who's against it in Minnesota? The Minnesota's Teachers Union. The Teachers Union is opposed to children having a civil right to a quality public education and then delivering on that civil right the state's highest priority. That's odd, isn't it? Well, there are some structures that benefit from the system as it is. And you got to be honest about it, and you got to confront that head on. Otherwise, we're gonna have dinners, and we're gonna have fundraisers, and we're gonna pat each other on the back. We're all doing good work, and 20 years from now, we're gonna be exactly where we are. And that is deeply disappointing.
I frequently quote a quote that's often attributed to Einstein, but I don't think he actually said this, but doing the same thing and expecting a different outcome is the definition of insanity. I think we'll all be watching your work with education really closely, because I know that the Baltimore Community Foundation, for example, has been, worked deeply with the city schools for, beyond a decade, and the struggles are very real. I would also say that, when you look at systems, how did we arrive here? And I think, the one of the things that we really need to think about is how we compensate teachers and how we value them and how we value education as a whole and as a society. And I would say that, there are countries where being an educator is a very well-paying and very appreciated role. And I think that there are things that we can learn there.
For sure, absolutely. And I'll tell you, we meet a lot of teachers, by the way, as Justice Page and I have traveled the state of Minnesota. We meet tons of teachers most of whom are doing fabulous work. And they say, yeah, we want a civil right for our children. We want education to be our state's #1 priority. But we found there's a big disconnect between the folks on the ground doing the work who are passionate about their kids that they're helping and some of the leaders that's not their focus.
Yeah, it's a difficult conversation for sure. And I think one that you're absolutely right, that the community foundations really can take a role in. And I know many have already, like Boston and other places. Just looking back over the last 18 months or so, what have you learned, both for you and the Fed, or just even personally, that would be good information for this group?
You know, so I was at the U.S. Treasury Department during the financial crisis of 08, 09. I worked both for Presidents Bush and President Obama. One of the things, and now, so, I mean, I never dreamt I'd be in the middle of another crisis a decade later. I thought that was a once in a lifetime event. You respond to a crisis with overwhelming force. And so we did learn from 08 to 2020, and Congress learned, and I really applaud, as dysfunctional as our political system is in many ways, I really applaud that leaders on both sides of the aisle acted so aggressively in response to the COVID shock, to get money in the hands of small businesses, to get monies in the hands of families that have lost their jobs. It wasn't perfect, but it was overwhelming fiscal firepower. And we at the Fed also learned. We brought overwhelming monetary policy firepower to make sure that this healthcare crisis did not turn into a broader financial crisis. And we learned from 08. We did some of the same things we did in 08, but we did them more aggressively this time, and we did them faster. And those are the right things to do. And so one of my takeaways from that is you don't respond to crisis with incremental solutions. You don't respond to a crisis with timid half measures. If you really have a crisis, you have to respond with overwhelming force. And that is now burned into me. That is like ingrained in my head. And so I say to your audience, if you feel like you have a crisis in your community, what does overwhelming force look like? How do you mobilize overwhelming force so that you can really put out the fire, address the crisis, get people back on their feet, and get them moving in a positive direction again? That's just over and over again. That keeps coming back to me. We need overwhelming force if we're really going to address some of these problems. And so what does that look like, and how do we deliver that?
I think that's incredibly insightful. And as someone who lived through too many financial crises now, I hate to say it, that's how I like keep track of my career by, the number of recessions I've worked through. But I think that is incredibly insightful about how to react, and I think the right things that the U.S. did in the midst of the pandemic. I think there were many right things, but as someone who worked personally on the payroll protection program, and I literally had people in my organization working overnight, 3 shifts to process it. I'm sure there's many criticisms we could find of how it was put together, but it was the right response at the time. And I can't tell you how many business owners I talked to who, were really at their wits' end, and it really saved them. It saved their businesses, and it saved them being able to pay their employees. And it was a great thing for the community, even though it was a really difficult thing to execute on at the time. But I think you're absolutely right. I thought that was incredibly insightful.
I'm glad you mentioned that. I mean, that's an example of a program that was conceived very quickly in the middle of a crisis, but it worked. And with the benefit of hindsight, academics will say, well, this could have been better, that could have been better. In the middle of a fire, you're trying to put the fire out. And if you want to go afterwards and audit the firefighters and saying, well, how much water did you use? And did you spray it optimally? Let the professors go do that. But the point is, it was effective because banks like yours and many banks in our community and the Federal Reserve and the Small Business Administration and the Treasury all came together with Congress's ultimate impetus to go put this out, and it was effective. Now, one of the challenges we discovered is that you had to have a banking relationship to get access, because there was no way for SBA or Treasury or the Fed to reach millions of businesses directly. There's just no way. We had to go through the banking system. And we worked through CDFIs as well, which played a very important role to play. But it didn't get everybody. There were some small businesses that didn't have a banking relationship or didn't have the records that they needed to be able to access the program. And so that's something that we need to learn from, which is, I think the program was effective, just like you said, but I think we can do better next time if we think about ways of making sure that all of those small businesses are either already connected to the banking sector or have channels for them so that they can participate in that time of national need. But overall, high marks, but also opportunities for us to learn for the future.
I'm glad you brought that up. I think that, and it goes back to our conversation about systemic disparities, right? So we have to go back and look at those disparities. And I think between, the first PPP and the second, some of that were corrected where more money did go to CDFIs. And I think our audience knows that that's a community development financial institution, but who can often lend to individuals and businesses that banks can't lend to. So that was a great channel. Also, we made the change, I think many institutions did, I can't remember if it was a mandate or not, to not just, you didn't have to have a business account, you have a personal account, because so many sole proprietors obviously do business out of their own personal banking account. So that was a group that was somewhat disadvantaged before as well. So to your point, I think there's many lessons learned. And I think it all goes back to, do our systems, create or enable disparities, or are we always thinking about, how do we reach everyone and give everyone an equal opportunity to participate?
Yeah, absolutely. Absolutely. And just to go back for a moment on the comment that I made about, overwhelming force. In a crisis, it is far better to do too much than too little. Far better. And I think some people say, well, we did too much in terms of the fiscal side. Maybe some people think the Fed did too much. It is far better to err that way than to do too little when you're in the middle of a crisis. And so I'm never going to forget that.
No, I think that's a terrific lesson. And I think it's one we can all take, because I know I said I was going to stay away from jargon, but I mean, I think the question a lot of people have is, was the pandemic a black swan event?
Here's the thing. We keep having these things. So everyone's like, oh, no. The 08 financial crisis, it's a 1 in 100 year event. Well, 12 years later, the Federal Reserve has to basically backstop the financial system again. And fine, it wasn't a real estate led financial crisis. This time it was a pandemic. And then there was Y2K where, oh my gosh, people were nervous. Is this going to bring down? So every 10 years, we end up having some calamitous event. And each of those individually might be 1 in 100 year pandemics and a 1 in 100 year financial crisis, but you have enough of them and it ends up being every decade. And so we need to be geared up as a Federal Reserve System, as a country, as the infrastructure that we have to be more resilient so that we can help people when these shocks happen. Because this pandemic was deeply unfair for the reasons that we already said, and nobody was at fault. This wasn't like somebody made a bad loan or somebody took out a loan they couldn't afford. This was a natural disaster hitting the US hitting the global economy all at once. And so we needed to support one another. And I think we did a good job overall as a country, but I think we've got more that we can do and better that we can do in the future.
Well, and that doesn't even take into account, I mean, I agree, it was a global event, right? But we've had plenty of regional events, mostly, weather climate related in the US this year, that when you have enough regional events going on simultaneously, that too is a crisis.
Absolutely. I think that is a great point. Between the forest fires and the hurricanes, and the flooding and whatnot, and the cold weather in Texas that shut down their power grid, it actually affected a lot more than just Texas. These things add up, and it's a lot of people end up getting affected by it. You're right.
But I think your insights on how to deal with a crisis are really pertinent, and because clearly these aren't one in a lifetime events. I've already lived through too many of them. So, and I hope to keep going. So I think it's something that we all have to adapt to and bring into our business plans and our community planning.
Yeah.
So this has been a great conversation, and I once again really appreciate your being willing to have this conversation. Is there something that you wanted me to ask that I didn't ask, or that you think's really pertinent to this group that you would like to get out now?
No, I thought this was a great conversation, and you covered really important topics. And I looked at the series that you all are hosting. It looks like a great series with great provocative speaker. So just thank you. Thank you for including me. Thank you for the work that you all are doing, your lifetime's work in these wonderful foundations. I think you guys can be enormously positive champions of systematic change, but we've got to be clear that that's what we're going after, and then I think we can do it. So appreciate the opportunity.
Well, thank you again, and thank you for the work that you and your colleagues at the Federal Reserve of Minneapolis are doing, as well as the Fed around the country. It is really, truly important work, and I have appreciated my opportunity to see into it a little more closely. And I wish you good luck with all of your efforts in Minneapolis.
Thank you very much. I appreciate it. And thanks again for your service on the Richmond Fed.
Thank you.